SEBI's barred US trading from Jane Street from Indian markets.
It banned one of Wall Street's biggest trading firms, Jane Street.
Did you know that 93% of Indian option traders lose money? That's right, almost everyone loses. Yet, one foreign firm just walked away with 36,000 crores in profit. If you trade Nifty or are even remotely interested in markets, you cannot afford to miss this story. Today, we're diving deep into SEBI versus Jane Street saga and why it actually matters to every Indian trader out there. I'm breaking this video in 3 parts. First, who exactly is Jane Street and what happened? Second, why should retail traders like you care? And lastly, where is the situation heading? So first things first, who is Jane Street and what exactly happened? Jane Street isn't just another investment bank, they're a global market maker. Famous for ultra-fast trading algorithms, these guys trade everything from ETFs to crypto and they're known for making markets super efficient. Their job is basically to provide liquidity to you and me. But here's what went wrong. On July 4th, 2025, SEBI dropped a massive 100-pager interim order against Jane Street. Here's what happened. First, SEBI barred 4 Jane Street entities from trading in Indian markets. Then, they froze 4,800 crores that SEBI is calling unlawful gains. And now, Jane Street has 21 days to respond. And what's the accusation? SEBI claims Jane Street manipulated Bank Nifty and Nifty 50 settlement levels by aggressively buying stocks in the morning, shorting index options, and then reversing both near market close. The result? Jane Street made a whopping 36,000 crores all between January 23 and March 2025. So why should you care if you're a retail trader? Here are 3 big reasons. First, price manipulation. Until now, Jane Street was manipulating the prices of options by trading in the cash markets. Also, you must have often seen that just before the expiry, markets made massive moves in which retail traders were wiped out. Those were made like giants like them. Second, liquidity illusion. Jane Street alone made up nearly 5% of Bank Nifty options trading daily. As soon as they got banned, option price spreads started to go up. Lastly, because of all this, market confidence has taken a big hit. This isn't just my view. Uday Kotak highlighted that there's a huge gap between derivative trading and actual stock market liquidity. SEBI could soon tighten weekly expiries or limit how much can anyone trade in these contracts. Now, how did the market react on 4th of July when all of this came out? Brokers like Nuama and Angel were dropped 7% in a single day because of their heavy exposure to FNO trading. Even though NSE trading volumes held up, the bid-ask spreads for Bank Nifty options shot up instantly from 0.75 rupees to 1.4 rupees for at-the-money contracts right after SEBI's ban. Now, SEBI is publicly assuring everyone that liquidity is stable and they're keeping a close watch on the situation. So what's next? Jane Street responded that they did nothing wrong. They were just providing liquidity, not manipulating prices. They are planning to appeal to SEBI by late July. So this story is far from over. This will potentially lead to regulatory changes. SEBI is already thinking about big changes, limiting to single weekly expiry, stricter algo tagging, and tighter position limits. This will impact other big international firms like Citadel. They are also watching these developments very closely. What does this mean for retail traders like us? We should expect tighter regulations, maybe less volatility, but probably higher margins, and stricter compliances in the coming months. Alright, now time for the big question. Do you think algo trading by these giants should have tighter regulations, or this is just fair competition? If you found this deep dive helpful, smash that like button and subscribe for more videos like this. See you in the next video.